Welcome back to the Week in Markets. My name's George Bell. I'm joined today by Matt Henderson. It's been a relatively short week in the UK, so we're going to extend this out over the month. And Matt, if we look back over the month, has it been a good month for equities and bond markets or a bad month?
Yeah, so over the month it's been actually quite a positive month for both equities and fixed income instruments. So generally for 60 portfolios, quite a favourable outcome over the month of May.
Excellent. What are you seeing in terms of key markets which are leading, which are the areas which are lagging, and is there any dynamics within that which underpin the direction we're seeing?
Yeah, so I think leadership's really come through within US equity markets over the sort of year-to-date period that we've had so far. But I guess for us as multi-asset investors, what's become quite encouraging is that we're actually starting to see that breadth expand. So it's not just US equity markets leading the entire way. We're starting to see pick up in performance from European markets, UK markets. Japan, I guess, has been a strong performer throughout the year. So starting to see that breadth come through in terms of regions. But if we think about the US equity market in terms of sector performance, that's still actually quite concentrated and quite narrow at this point in time.
And where are returns really concentrated in the US?
Yeah, so it's all coming through really in the technology sector. As we've gone through earnings season in the US, we're continuing to see companies talk about this AI theme. And those companies really within the US, which are the main beneficiaries of AI. So really what we're seeing is the tech sector lead the way, but also we're seeing companies who are qualified or classed as quality really leading the way. So we're looking at those with better return on equities, better balance sheets, lower debt, etc. really lead the way for markets so far this year.
It's quite an interesting development there. It's still technology businesses in the US which are driving a lot of the force of the stock market, driving that leadership. But regionally, we're starting to see that broaden out as well and getting some positive returns outside of the States as well.
Yeah, and there's a number of factors really, George, that are driving that. You know, we're seeing the narrative that we've spoke about in these videos before of disinflation really continuing to play through in places like Europe, also here within the UK. Within the US, that dynamic's slightly different. So we're seeing inflation being slightly higher than both the UK and Europe, but it's also remaining at a more sticky, elevated level. And as we've spoke about previously, it's mainly been driven by the strength of services within the US.
I think that's a really important point, actually, the strength of services, the strength of economic growth in general in the United States, which has just been putting some upward pressure on inflation, which we've seen coming through. If we look outside of the United States, we're seeing a very different sort of dynamic. We're seeing inflation, which is coming down at quite an accelerated rate in Europe, in the UK as well. So you've got some slightly different dynamics which are going on. But in general, economic growth and inflation seems to be in a range which markets are taking well, they're digesting pretty well. Is that fair?
Yeah, and I think from some of the work we've certainly looked at as an investment team, if we see inflation within the range of 2 to 4%, that's a good backdrop for equities because it boosts nominal GDP, that feeds through into revenues for companies. So when you drop that through and it comes through in terms of profit, it's actually still quite positive for equities, but it can be a bit more problematic for fixed income, which I guess is the backdrop we've been through for probably the past 18 months.
In the UK market, you know, we've had quite a bit going on over the last month. We've had an election call in the middle of the month. How's the UK market performed? Yeah,
so UK market's actually been positive, strong. I guess when we look at the UK, we can put it into two different buckets. We can look at the FTSE 100, which is more internationally orientated, or the FTSE 250, which is more domestic stocks. And I think what's quite interesting for us is that when you look at that performance, we've actually seen stronger performance from the domestic names. And I think that's just due to some of the more positive economic data we've had coming through recently from the UK. You know, we've already spoken about the disinflation. If we look at things like economic surprise indices, which basically measure how good or bad is data relative to estimates, that's been pretty positive for the UK. So essentially data has been better than what the market had been expecting, and that's really driven domestic stocks to outperform their international counterparts. And really what's also interesting for us as an investment team is that despite that general election call that's been made earlier this month, it's not really had an impact on UK equities.
Yeah, I think that's a key thing, a big announcement, but the market has generally taken it in its stride. Just in terms of other aspects which we note, we're recording on the last day of the month here, so still a few hours to go before trading closes. But what we're seeing is trends in corporate profits, which are looking fairly robust if we look over the course of the month. I think, at this point in time, 78% of companies in the US are reflecting earnings which are better than what they initially revised towards. Only 3 sectors where you're not really seeing that coming through: materials, energy, discretionary. And in terms of the earnings growth which we're seeing for the first quarter, US companies are expecting to see growth of around 6% relative to the same quarter last year. So we've seen a range of different environments. We've seen a number of trends which are coming through, but the key ones are inflation and economic growth appear to be in a range where companies can digest that well, can continue to expand, and we're seeing that come through in terms of stock market returns as well.
I guess in terms of the revision data you spoke about as well, we're sort of seeing that in not just the US, we've seen that in other developed markets too, where we're seeing places like the UK, Europe, they're also having earnings estimates revised higher, and it just speaks to the more positive global backdrop that we're seeing in terms of growth.
You mentioned government bonds earlier. Could you just give us a bit more context in terms of how government bonds performed through the course of the month, and then we can maybe look at corporate bonds as well?
Yeah, so in the UK, bonds are roughly flat, so there hasn't been much movement in terms of those bond yields over the month. I think where we've seen the main changes within US Treasuries, so US government bonds, where they've actually moderated more over the month, and that's really had a play-through factor in terms of currency markets, where we've seen the US dollar weaken relative to sterling, and that links back into the point we made earlier around the difference between the international stocks in the UK and the more domestic ones, where those international stocks have suffered that headwind of the currency strengthening as it just comes through in the translation effect of their earnings.
In company bonds, if you hold a company bond, you want a bit more compensation for the risk which you're taking relative to a government bond. But given the backdrop of robust economic growth, inflation coming down, corporate bonds have actually been pretty well behaved through the course of the month, given all of the data which has been thrown at them. Fairly decent outcome there.
Yeah, so investors are pretty much happy that companies will generate enough profits and revenues to be able to repay their coupons. So as you said, that extra element of return you want, known as the spread, they've remained pretty tight throughout the month.
So just bringing it all together, generally a good month for market returns. Data in respect of growth, inflation and corporate profits appear to be well digested by the markets. You're seeing more international breadth which is coming through in respect of stock markets as well, which is beneficial for a multi-asset portfolio. And even with a raft of economic and political announcements, bond markets have been fairly well behaved in that environment.
Absolutely.
So thanks very much, Matt. Great update. And please join us next week for our weekend markets.